In this video, I'm going to talk about the three main types of life insurance. There's term life, there's whole life, and there's universal life. For those of you that don't know who I am, my name is Pascal and I work with Thrive Wealth Solutions, and we essentially help people take what normally is a 40 to 45 year goal and change it to a 20 to 25 year goal by using simple private banking strategies. If you want to learn more about that, I'll link a video at the end that you could watch to learn more on how that concept works. But for today, I'm going to talk about these three forms of life insurance. So when it comes to getting life insurance, there's three things that have an overall impact in terms of the cost of whatever insurance policy that you're getting. There's your age, there's your sex, and then there's your health. Obviously, when it comes to age, it's going to cost more for someone, say, 40 years old to get an insurance policy than it is for someone 20 years old to get an insurance policy. For the reasoning being that it's more likely for you to pass away the older you become. And then there's the other component of health. Depending on how healthy you are, the insurance company could either approve or disapprove your policy. And what the insurance company will do is that they will also rate you based on health too as well. So based on what type of health rating you are, your cost of insurance is either going to be more or less. Obviously, the healthier you are, the less the cost of insurance is going to be. And then the alternative, the less healthy you are, the more the insurance is going to cost, because it's going to be more risk for the insurance company to insure you. And lastly, there's the sex part. And the reason why that matters is because women tend to live longer than men. So the cost of insurance to insure men is going to be higher than the cost of insurance to insure women. So now that we got those variables out of the way, let's talk a little bit about the different types of insurance policies out there. The first type of insurance and the simplest type of insurance is a term insurance policy. Considering that you're younger, around like say 20 to 40, is the cheapest form of life insurance that you could get. Some people say things that they can't afford life insurance, right? Because it's too expensive and things of that sort. Well, if you look at the statistics for Americans today, about 7 out of 10 or 70% of Americans live paycheck to paycheck, and about 60% of Americans can't afford a $1,000 emergency. So in reality, they can't really afford not to have it. Because if you think about people that are in those situations where they don't have a lot of money saved up, they have wife, kids, and all those other obligations that they have to take care of, they really can't afford to die essentially. Because the family isn't going to be able to sustain their same lifestyle if they depend on that income coming in. And that's why everyone over the age of 18 should have some life insurance in place, even if it's just a term insurance policy. And the way a term works is basically you could get a 20-year term, say for like $200,000 or $250,000 or whatever that benefit that you want. And essentially, there's no cash value built up in the term insurance policy. It's just meant to cover you for a period of time. And during that period of time, it's going to be really important to make sure you get your savings into a better place and also your investments as well as you're getting covered for that term. And really the only purpose of it is when you're in a position where you don't have a lot of money and you have tons of liability or you have people that depend on you, that's when you get a term insurance policy. And literally for someone the age of 25, they could get a $300,000 term for only around $20 to $30 a month. So it's not really expensive. So when people say that it's expensive, that's not necessarily true. At some point when you're making more consistent income and you're having savings and you're in a more stable financial position, getting cash value life insurance policy is going to be better considering it's structured for max cash accumulation. And I'm not going to get too much in this video about that. I'll link a video at the end that you could watch if you want to learn about how that works. But today I'm just going to be specifically talking about the different types of insurance out there. But one interesting thing when it comes to life insurance, it's really the only product that can guarantee an outcome. Now, what do I mean by that? If you think about someone that's really good at saving, really good at investing their money, and they really have good financial habits, they'll eventually get to the point where they're a millionaire or multi-millionaire just by having those habits for a long enough period of time. But no one says they're actually going to live that long to actually wait to see their money grow like that. So the really only way to bridge that gap from how much you have now, in order to bridge that gap until you are a millionaire, having a life insurance in place basically locks in that potential that you have to do that. Because if you happen to pass away too soon, even if you put in one premium into your life insurance policy, that death benefit has to be passed down to the beneficiary of your choice because that's how an insurance contract works. The thing is, term insurance is typically cheap when you're younger, so it really makes sense if you're in a position where you don't have a lot of money and say you're in your 20s to 40s, somewhere around that range. That's when a term insurance policy makes sense. But when you start getting to the point when you're in your 60s, it really doesn't make a lot of sense because it ends up being really expensive and there's a good chance it's not going to end up paying off because most terms do not pay off. actually around over 90% of them don't actually pay out. Not because the insurance companies don't actually pay out the claim because they don't want to, it's just because they don't actually pay out, like the term usually expires before they pass away. The next type of insurance is called whole life insurance, which is a type of permanent insurance policy. And basically the way it works is some of it goes into the cost of insurance and fees of the insurance policy. Another part goes into a cash value component. And some of the benefits when it comes to having a cash value life insurance policy is that it accumulates tax-free and you could access your money tax-free prior to age 59 and a half, like a lot of retirement accounts that give you that restriction. And some people might wonder, where does that money actually go in a cash value life insurance policy? There's something known as an insurance general account where you get a credit of around 3 to 4%. And the way they get that credit rate is they put that money into high grade bonds. So things like government bonds, A-rated corporate bonds, and really high grade, low default bonds where they just get a simple 3 to 4% rate of return on it. And that's basically how you get paid in a whole life insurance contract or in a general account of an insurance company. And the benefit is you get the guarantees of an insurance contract without market risk, and you have that locked in rate of return in a whole life insurance policy. You could typically get around, like I was saying, 3 to 4% in these policies. But the only purpose to get a policy like this is to leverage. You don't want to replace your investments with a whole life insurance policy. So if it's not a high cash value policy where you don't have, say, 80% access to your money in the first year or two, you probably shouldn't get into it at all because you don't want to replace your investments with an account that only earns 3 to 4%. You want to be able to leverage that asset to buy other assets that it could accumulate at a higher return than just that whole life insurance policy. This is also one of the most expensive types of life insurance because it's a guaranteed death benefit. Considering that you have, say, a 10-pay or 20-pay whole life insurance contract, the insurance company has to essentially guarantee to pay that out regardless if you don't even put another premium into that whole life insurance policy. And that makes the death benefit more expensive than other policies that you could get into, which I'll elaborate on later on in this video. The next type of policy there is universal life insurance policy. Similar to a whole life insurance contract, when you put your money in a universal life insurance policy, some of it goes to the cost of insurance and fees, and another part of it goes into a cash value component. But the difference between a universal life and a whole life insurance policy is that for universal life policies, for the most part, the death benefit is not guaranteed, meaning the policy will be enforced if it has sufficient cash value in the policy to take care of the cost of insurance and other fees that are related to the life insurance policy. But the benefit of it is that the cost of insurance starts off a lot less than a whole life insurance contract, which gives the universal life insurance contracts the ability to accumulate faster and higher than a whole life insurance contract. Because universal life policy use something called annual renewable term, meaning the cost of insurance per unit gets higher as you get older every single year. So some people might ask, wouldn't that mean that eventually at some point the cost of insurance in a universal life contract be more than a whole life insurance contract? Well, that's not necessarily true because there's something known as a net amount at risk. So that's basically what the insurance companies would be charging you on. Say, for example, you have a $500,000 death benefit, and say you have $30,000 worth of cash value in your life insurance policy. So what the insurance company is going to charge you is something known as a net amount at risk, which is basically that $500,000 minus that $30,000, which is only $470,000. And that's basically, that $470,000 is the amount of insurance you're getting charged on, not that entire $500,000. And you continuously put in premiums into your life insurance policy, is going to end up getting lower and lower, considering you're using something called a level death benefit when it comes to universal life policies. And that's basically how you lower the cost of insurance. And actually, the cost of insurance should get lower as you get older if it's structured in the proper way. But to kind of get into the different types of universal contracts there are, there's plain universal life, where it's similar to a whole life insurance policy. It doesn't pay dividends like some whole life insurance policies do, but that money basically goes into the same general account, but it's just a non-guaranteed death benefit. That's how a universal life policy works. And it's gonna grow around 3 to 4%, similar to the same as a whole life insurance policy, and potentially a little bit less. But there's also other ways where you could participate in things like different index accounts, where it's called index universal life insurance policies, where you could participate in the gains of the S&P 500, not directly investing into it, because actually index universal life insurance policies are still fixed contracts. So what do I mean by that? They're not actually taking your premium dollars and taking risk with your money. So how does that work? So essentially, let's say you have 30 grand in terms of money that you're putting into this insurance policy every single year. Sounds like a lot, but most of this policy is liquid considering it's structured in a way where you could get 80 to 90% access. But to kind of go on with the point, if you put in 30 grand at one time, say into the cash value life insurance policy, what the insurance company is going to do is put that money into the insurance general account. And basically the insurance companies get the 3 to 4% credit on that $30,000. So let's say they got 4% on $30,000. That's $1,200, right? So essentially what the insurance company is going to do with that money they got by putting it into the general account, they're going to buy yearly point-to-point options of S&P 500. So basically, they're using the free money that they got in terms of interest in the general account to buy these options. And that's basically how you get credited. And the IULs, or the Index Universal Life policies, will typically have something like a cap of around 10% and a floor of 0. So meaning if those call options perform better than 10%, say it performs 20%, you're capped at 10%. But the market goes down 20%, you're guaranteed a 0% floor. But they never actually use your money to put that money into the call options. They use the money that you get in terms of interest from your insurance policy to invest in those call options. And that's why you never actually lose money due to market risk in an Index Universal Life policy, because you're not actually taking any market risk doing that. And then there's the riskiest form of life insurance there is, which is also known as Variable Universal Life Insurance. So similar to all the other permanent contracts, there is the cost of insurance and fees that are associated with the accounts. And also there's a separate account which is invested into things like mutual funds, where it's directly invested in the market. This is actually the most expensive form of life insurance, the Variable Universal Life Insurance contract. Because not only is there the cost of insurance and fees that are already associated with the contract, there's also the investment account fees that the money is getting put into mutual funds for. And the big reason why it's very risky is because when the markets do go down, let's say we use that same example of that $500,000 that you have in terms of death benefit and you have $30,000 of premium. If your money goes down, say 10%, so 10% of $30,000 is what? $3,000, right? Which means you're only gonna have $27,000 in terms of cash value in your policy. The problem with that is now your net amount at risk gets bigger, because the amount of cash value that you had in your insurance policy drops. So the market can take some big jumps and big drops. So that discrepancy between the death benefit and your cash value is going to make the insurance company's net amount at risk increase drastically. So that's what makes it more risky, because there's the element of also the stock market doing its dives in terms that it can do, and then the potential of your cost of insurance increasing. So for me personally, I would invest in a brokerage account first before I would put my money in say a Variable Universal Life policy, just because of that. You can't really use it to leverage, and you can't use it for banking really, because it's not really a place you could save money, because you're taking investment risk by doing it. The only way you could really save your money or have a savings alternative is by using say whole life policy or Index Universal Life policy. You're not going to really get that out of a Variable Universal Life policy. So this is just some of the simple points when it comes to the different types of permanent and term insurance contracts out there. There are different things, add-ons like riders. Some riders give you lifetime income, where you could actually attach it to a life insurance contract and it'll pay you income for the rest of your life. And there's things like long-term care riders, in case you get sick and you can't do some of the daily activities of life, that'll actually pay you some of your death benefit as you're alive. And there's different type of riders. I might talk about that later on in some of my other videos, but I just wanted to keep it simple and kind of break down the different forms of life insurance. So if you find content like this valuable, I talk a lot about different types of financial content and financial concepts. So if you want to learn about ways to basically take what normally would be your 40 to 45 year goals to 20 to 25 year goals, I highly recommend following and subscribing to this channel. And I make videos like this every single week, so if you enjoy content like this, make sure you follow. Thank you, and I'll see you guys next time.